Surety bond risk profiling and assessment techniques are essential components of underwriting that demand a meticulous evaluation of a contractor's financial stability, work history, and project feasibility. The process begins with a foundational understanding of a contractor's financials, which serve as a quantitative representation of their ability to meet obligations. This includes analyzing balance sheets, income statements, and cash flow statements. Each document offers unique insights. Balance sheets reveal the contractor's asset-liability structure, income statements illustrate profitability trends, and cash flow statements highlight liquidity and operational efficiency. The key financial ratios, such as the current ratio, debt-to-equity ratio, and gross profit margin, serve as primary tools for assessing financial health. A current ratio below 1, for instance, may signal liquidity concerns, while an overly leveraged debt-to-equity ratio can indicate excessive dependence on external financing, increasing default risk. Beyond quantitative measures, qualitative factors such as the contractor's work history provide critical context. Historical data on completed projects, including scope, timelines, and outcomes, allows underwriters to assess performance consistency and operational capacity. Contractors with frequent project delays, cost overruns, or disputes signal potential risks that quantitative measures alone may not capture. Similarly, the geographical and industry-specific nature of past projects plays a pivotal role. Contractors accustomed to regional or smaller-scale projects may face challenges adapting to the regulatory, logistical, and financial demands of larger or out-of-state undertakings. To supplement traditional methods, predictive modeling has emerged as a transformative tool in risk assessment. Advanced models integrate financial, operational, and market data to estimate default probabilities. These models leverage machine learning algorithms and statistical methods to identify patterns and correlations in vast datasets. For example, logistic regression can be used to predict default likelihood based on variables such as financial ratios, macroeconomic indicators, and project complexity. The integration of external data, such as credit scores, economic forecasts, and construction industry trends, further enhances model accuracy. Predictive models can also quantify risk sensitivity, allowing underwriters to simulate the impact of varying conditions, such as interest rate hikes or material cost inflation, on the contractor's default probability. However, the effective use of predictive models requires careful validation and interpretation. Data quality is paramount, as incomplete or inaccurate information can lead to flawed predictions. Additionally, underwriters must remain cautious of over-reliance on models, as they often cannot account for nuanced factors such as management stability or unforeseen market disruptions. This brings attention to red flags that may arise during risk assessment. Beyond financial ratios, indicators such as a sudden turnover in key personnel, frequent litigation, or reliance on a limited pool of subcontractors can signal underlying instability. For instance, abrupt changes in management often disrupt operational continuity, leading to inefficiencies and increased risk. The process of integrating credit, market, and operational risks into a cohesive underwriting framework adds another layer of complexity. Credit risk involves assessing the contractor's ability to meet financial obligations based on historical repayment behavior and external borrowing capacity. Market risk examines external factors such as material price volatility, labor shortages, and regional economic conditions that can affect project viability. Operational risk focuses on internal inefficiencies, including mismanagement, insufficient project planning, or inadequate resource allocation. Combining these dimensions requires an interdisciplinary approach that synthesizes financial analysis, economic forecasting, and operational auditing. By aligning these factors, underwriters can construct a comprehensive risk profile that reflects both the contractor's intrinsic capabilities and the external challenges they may face. Historical context further enriches this analysis. The evolution of surety bond underwriting has been shaped by lessons from past economic cycles, such as the 2008 financial crisis, which underscored the importance of liquidity and diversification in mitigating risk. Case studies from that period reveal how contractors with diversified revenue streams and strong cash reserves were better positioned to weather the downturn, while those reliant on speculative projects faced heightened default rates. Similarly, advancements in data analytics and risk management frameworks have drawn inspiration from fields such as banking and actuarial science, emphasizing the value of cross-industry knowledge transfer in refining underwriting practices. Contemporary debates in surety bond underwriting focus on balancing traditional methods with technological advancements. While predictive analytics and automation offer efficiency and precision, they also raise questions about the diminishing role of human judgment. Critics argue that quantitative models may fail to capture the subjective elements of risk assessment, such as contractor reputation or local market nuances. Proponents, however, highlight the potential of AI-driven tools to reduce bias and enhance consistency in underwriting decisions. This tension between technology and expertise reflects broader shifts in the insurance industry, where innovation must coexist with the tacit knowledge and experience of seasoned professionals. As the underwriting process continues to evolve, the integration of emerging technologies and interdisciplinary methodologies will shape the future of surety bond risk assessment. Advanced tools such as blockchain for verifying collateral and project milestones, as well as real-time data analytics for monitoring project performance, are poised to redefine how underwriters approach risk profiling. However, the fundamental principles of evaluating financial health, operational capacity, and external risk factors will remain central to the discipline, ensuring that underwriters can navigate the complexities of modern construction projects with confidence and precision. Advanced financial statement analysis for surety underwriters is a critical skill that combines technical knowledge of accounting principles with practical tools tailored to the unique challenges of construction firms. At the heart of this analysis lies ratio assessment, which involves using liquidity, solvency, and profitability metrics to evaluate a contractor's financial health. Liquidity ratios, such as the current ratio and quick ratio, provide insights into a firm's ability to meet short-term obligations. For example, a current ratio below 1 often suggests a contractor may struggle with immediate liabilities, which can signal risks in project continuity. Similarly, the quick ratio refines this analysis by excluding inventory, focusing on readily available liquid assets. These ratios must be interpreted alongside the contractor's payment schedules, as delayed receivables can exacerbate liquidity pressures, particularly during large-scale projects. Solvency ratios, including the debt-to-equity ratio and interest coverage ratio, evaluate the contractor's long-term financial stability. A high debt-to-equity ratio can indicate over-leverage, reducing the firm's resilience to economic downturns or project-specific setbacks. In the construction industry, where payment cycles can be irregular and cost overruns frequent, maintaining an optimal balance between debt and equity is paramount. The interest coverage ratio complements this by measuring the contractor's ability to meet interest expenses from operating profits. This metric becomes particularly critical in periods of rising interest rates, where increased borrowing costs can erode profitability. Profitability ratios, such as gross profit margin and net profit margin, reveal whether a contractor's revenue streams are sufficient to sustain operations and generate profit. These metrics, however, must account for construction-specific nuances, such as variable labor costs, material price fluctuations, and subcontractor expenses, which can distort traditional interpretations. Beyond ratios, assessing backlog reports and work-in-progress schedules offers a deeper understanding of the contractor's operational and financial dynamics. Backlog reports quantify the value of uncompleted projects, serving as an indicator of future revenue potential. However, an excessively high backlog relative to available resources can signal overextension, risking delays and quality issues. Conversely, a shrinking backlog may suggest declining demand or inefficiencies in securing new projects. Work-in-progress schedules, which detail the progress and financial status of ongoing projects, are equally critical. These schedules help identify overbilling and underbilling risks, common pitfalls in construction accounting. Overbilling, where contractors invoice more than the actual work completed, can inflate revenue and mask underlying cash flow problems. Underbilling, on the other hand, occurs when contractors underreport completed work, leading to delayed revenue recognition and distorted profitability metrics. Both scenarios can significantly misrepresent the contractor's financial position, underscoring the importance of detailed scrutiny. Forensic accounting techniques further enhance the underwriter's ability to detect irregularities in financial reporting. These techniques involve analyzing financial statements for inconsistencies, anomalies, or patterns indicative of fraudulent activity. For instance, sudden spikes in revenue without corresponding increases in project activity or unexplained fluctuations in material costs may suggest revenue recognition manipulation or expense concealment. Comparative analysis across reporting periods, combined with industry benchmarking, can uncover discrepancies that traditional methods may overlook. Techniques such as Benford's Law, which analyzes the frequency distribution of leading digits in financial data, can also flag potential fraud. This level of scrutiny is essential in an industry where thin margins and high competition may incentivize contractors to present overly optimistic financial results. Advanced tools like Altman Z-scores and cash flow adequacy ratios add another layer of analytical depth. The Altman Z-score, originally developed as a bankruptcy prediction model, has been adapted for construction firms to estimate default risk. By incorporating multiple financial ratios, such as working capital to total assets and retained earnings to total assets, the Z-score provides a composite risk assessment. Contractors with low Z-scores may warrant closer monitoring or higher collateral requirements. The cash flow adequacy ratio, meanwhile, measures a firm's ability to generate sufficient cash flow to cover critical obligations, such as debt repayment and capital expenditures. This metric is particularly valuable in assessing the sustainability of contractors with heavy upfront costs or significant equipment investments. Historically, financial statement analysis in surety underwriting has evolved from reliance on manual review to incorporating advanced analytical models and technology. The shift from static spreadsheet analysis to dynamic tools capable of real-time monitoring has revolutionized risk assessment. These advancements draw on interdisciplinary connections, blending accounting, finance, and data analytics to create a more comprehensive approach. For example, integrating economic indicators such as regional construction activity and material price indices into financial models provides a broader context for evaluating contractor performance. This interdisciplinary perspective ensures that financial statement analysis is not conducted in isolation, but reflects the complex interplay of internal and external factors affecting the construction industry. Contemporary debates in this field often center on the role of automation and artificial intelligence in financial analysis. Proponents argue that AI-driven tools can enhance accuracy, efficiency, and consistency by processing large volumes of data and identifying patterns beyond human capability. Critics, however, caution against over-reliance on technology, emphasizing the importance of human judgment in interpreting qualitative factors and contextual nuances. For example, while algorithms can flag anomalies in financial data, they may not account for industry-specific factors such as seasonal variations or unique contractual terms that affect cash flow patterns. This tension highlights the need for a balanced approach that leverages technology while preserving the underwriter's expertise and critical thinking. As the construction industry continues to face challenges such as labor shortages, regulatory changes, and economic volatility, the importance of advanced financial statement analysis cannot be overstated. By combining rigorous quantitative methods with qualitative insights and interdisciplinary frameworks, underwriters can navigate these complexities and make informed decisions that balance risk and reward. This iterative process, rooted in continuous learning and adaptation, underscores the dynamic nature of financial analysis in the evolving landscape of surety underwriting. Collateral management and indemnity structuring in surety bonds is a complex and critical aspect of underwriting, requiring an intricate understanding of financial instruments, legal frameworks, and risk mitigation strategies. The selection and management of collateral types, cash, letters of credit, real property, and securities, serve as the foundation for securing a surety's exposure. Cash collateral is the simplest and most liquid form, offering immediate accessibility and minimal depreciation risk. However, its use often ties up the principal's working capital, which can strain operational liquidity, especially for contractors managing multiple projects. Letters of credit issued by financial institutions provide a similar level of security, but introduce the additional layer of institutional risk, requiring underwriters to assess the issuing bank's creditworthiness. Real property, as collateral, introduces considerations of valuation, market liquidity, and potential depreciation. The value of real property can fluctuate due to market conditions, necessitating periodic reappraisals to ensure its adequacy over time. Securities, such as stocks or bonds, offer a dynamic form of collateral but are subject to market volatility, requiring active monitoring and margin adjustments based on fluctuating values. The crafting of indemnity agreements is equally nuanced, involving decisions between individual and corporate indemnity. Individual indemnity agreements hold personal guarantors accountable, leveraging their personal assets as collateral. These agreements are often used when corporate resources alone are insufficient, or when the principal is a closely held business. However, individual indemnity introduces challenges related to asset tracing and enforceability, especially in jurisdictions with stringent homestead protections or exemption laws. Corporate indemnity, on the other hand, binds the entity to the agreement, offering a broader asset base but often requiring higher levels of due diligence to ensure the company's financial stability. Advanced indemnity structures may combine both individual and corporate elements, creating a layered approach that maximizes security for the surety while distributing liability among multiple guarantors. The calculation of collateral adequacy is a dynamic process that requires regular monitoring to account for changes in asset value, market conditions, and the evolving scope of the bonded obligation. Adequacy is typically assessed by comparing the collateral's liquidation value against the maximum foreseeable exposure of the surety. Liquidation value takes into account potential transaction costs, depreciation, and time-to-sell factors, ensuring that the collateral can realistically cover the surety's loss in the event of a default. For instance, a real property collateralized at face value without accounting for potential foreclosure delays or market downturns may lead to a shortfall during enforcement. Monitoring involves periodic audits, appraisals, and third-party verification to ensure that the collateral remains sufficient and unencumbered. Advances in technology, such as blockchain-based asset tracking, are beginning to enhance transparency and efficiency in this monitoring process. Perfecting security interests under UCC Article 9 is a legal cornerstone in collateral management, ensuring that the surety's claim to the collateral is legally enforceable and has priority over competing claims. Perfection involves several key steps, starting with the proper identification of the collateral and execution of a security agreement. This document must clearly describe the collateral and specify the terms of the security interest. The filing of a financing statement with the appropriate jurisdiction is a critical step in perfection, creating a public record of the surety's claim. However, the effectiveness of this filing depends on its accuracy, including the correct identification of the debtor, collateral, and filing location. Errors in these details can render the security interest subordinate or even unenforceable, exposing the surety to significant risk. In addition to filing, possession or control of the collateral may be required in certain cases, such as when dealing with securities or deposit accounts, to establish priority under Article 9. Historically, the evolution of collateral and indemnity practices has been shaped by the changing landscape of financial and legal risk. The economic volatility of the 20th century, including the Great Depression and subsequent banking crises, underscored the need for robust collateral mechanisms to protect against systemic defaults. The development of standardized practices under the Uniform Commercial Code in the mid-20th century was a pivotal moment, introducing a cohesive framework for managing security interests across jurisdictions. These historical contexts highlight the importance of adapting collateral and indemnity practices to reflect contemporary economic conditions and regulatory requirements. Interdisciplinary connections further enrich the understanding of collateral management and indemnity structuring. Insights from financial economics inform the valuation and risk assessment of different collateral types, while legal expertise ensures compliance with jurisdiction-specific regulations. Behavioral economics offers an additional layer of analysis, exploring how principals perceive the cost and benefit of providing collateral or indemnity. For instance, principals may undervalue the long-term implications of tying up liquid assets as collateral, prioritizing immediate project funding over future financial flexibility. Such behavioral tendencies can influence underwriting decisions, requiring careful negotiation and education during the indemnity structuring process. Contemporary debates in collateral management center on the balance between security and accessibility. While sureties seek to maximize collateral coverage to mitigate risk, principals often resist measures that constrain their operational liquidity or growth potential. This tension is particularly pronounced in industries like construction, where cash flow is critical, and access to working capital can determine project success. Advances in technology, such as AI-driven risk models and real-time collateral tracking, are reshaping these debates by providing more precise and adaptive solutions. For example, dynamic collateral agreements that adjust requirements based on project milestones or financial performance are gaining traction as a means to balance the interests of both parties. As economic conditions continue to evolve and regulatory landscapes shift, the strategies and tools for collateral management and indemnity structuring will need to adapt accordingly. The integration of advanced analytics, legal innovations, and interdisciplinary insights ensures that sureties can effectively navigate these complexities, safeguarding their interests while fostering sustainable relationships with principals. Construction contract analysis for surety bond underwriters is an intricate process that demands a comprehensive understanding of contract law, project management principles, and risk mitigation strategies. The foundation of this analysis begins with identifying key clauses in construction contracts that have direct implications for surety obligations. Payment terms, for instance, define the timing and conditions under which contractors and subcontractors are compensated. These terms influence cash flow dynamics and directly impact the likelihood of disputes or delays. Payment clauses may specify milestones, retainage percentages, or contingent payment structures, such as pay when paid or pay if paid clauses. The former requires the contractor to pay subcontractors within a reasonable period after receiving payment from the owner, while the latter ties subcontractor payment directly to the contractor's receipt of funds. The enforceability of these clauses varies by jurisdiction, making it critical for underwriters to understand local legal frameworks and their potential effects on project liquidity and performance. Change order provisions are another critical element as they govern modifications to the project's scope, cost, or timeline. Poorly defined change order processes can lead to disputes over whether additional work is within the original contract's scope or requires separate compensation. This ambiguity often results in cost overruns and project delays, increasing the likelihood of claims against the surety. Effective change order clauses should include clear procedures for initiating, approving, and documenting changes, along with specified timelines for submission and resolution. Termination rights, which detail the circumstances under which a contract can be terminated, are equally significant. Contracts may allow termination for cause, such as non-performance or breach of terms, or for convenience, which enables the owner to terminate without specific fault. Termination clauses must address the allocation of costs, the return of equipment or materials, and the resolution of outstanding payments. For sureties, the activation of a termination clause often triggers bond obligations, necessitating careful evaluation of its language and implications. The assessment of subcontractor default risk requires an in-depth understanding of pass-through clauses, which extend the contractor's obligations to subcontractors. These clauses often stipulate that subcontractors are bound by the same terms and conditions as the primary contractor in relation to the owner. While pass-through clauses can streamline project management, they also transfer significant risks downstream. For example, if a subcontractor defaults or fails to meet performance standards, the contractor remains liable to the owner, potentially triggering claims against performance bonds. Underwriters must evaluate the financial stability and track record of key subcontractors, as well as the mechanisms in place for dispute resolution and performance monitoring. This analysis is particularly critical in projects involving multiple tiers of subcontracting, where communication and accountability challenges are amplified. Techniques for evaluating project scope, cost escalation clauses, and contingency provisions are essential for identifying and managing risks associated with construction contracts. The project scope defines the deliverables, timelines, and quality standards expected of the contractor, serving as the basis for all subsequent project activities. A well-defined scope minimizes the risk of misunderstandings or disputes, while an ambiguous scope creates opportunities for misalignment between stakeholders. Cost escalation clauses address the potential for increased material or labor costs over the project's duration. These clauses are especially relevant in volatile markets or long-term projects where inflation, supply chain disruptions, or regulatory changes may significantly impact costs. Effective cost escalation provisions specify the conditions under which adjustments can be made, the methods for calculating increases, and the documentation required to support claims. Contingency provisions, on the other hand, allocate funds or resources to address unforeseen events, such as design errors, natural disasters, or unanticipated regulatory changes. Underwriters must assess whether the contingency budget is adequate relative to the project's complexity and risk profile, as well as the mechanisms for accessing and replenishing these reserves. Incomplete or ambiguous contracts pose one of the most significant risks to sureties, as they often lead to disputes, delays, and cost overruns. Methods to identify and mitigate these risks include conducting thorough pre-execution reviews, engaging legal and technical experts, and utilizing contract management software to track obligations and performance. Ambiguities may arise from undefined terms, conflicting clauses, or missing details, such as incomplete payment schedules or insufficiently detailed project specifications. Identifying these gaps requires a meticulous review of the contract language, cross-referencing related documents, and consulting industry standards to ensure clarity and consistency. Once identified, ambiguities can be mitigated through amendments, addenda, or supplementary agreements that address specific issues without altering the overall intent of the contract. Historically, the importance of robust contract analysis in surety underwriting has been underscored by high-profile construction failures and legal disputes. The construction of the Sydney Opera House, for instance, highlighted the consequences of poor contract management, including incomplete scope definitions, inadequate contingency planning, and contentious change orders. Lessons from such projects have informed the development of modern contract templates, such as those provided by the American Institute of Architects or the Consensus Docs Coalition, which aim to standardize best practices and reduce ambiguity. Interdisciplinary connections further enhance the underwriter's ability to analyze construction contracts. Insights from project management disciplines, such as earned value management and critical path analysis, provide quantitative tools for tracking project performance relative to contractual obligations. Legal expertise ensures compliance with jurisdiction-specific regulations and case law, while economic analysis informs the evaluation of market conditions and cost escalation risks. Behavioral science also plays a role in understanding how stakeholders interpret and respond to contractual incentives, penalties, or ambiguities, offering valuable context for risk assessment. Contemporary debates in construction contract analysis often revolve around the integration of technology and automation. Proponents of contract lifecycle management software argue that digital tools enhance accuracy, efficiency, and accountability by centralizing contract data and automating key processes, such as compliance checks or change order tracking. Critics, however, caution against over-reliance on technology, emphasizing the importance of human expertise in interpreting nuanced or context-specific contract language. These debates reflect broader tensions between innovation and tradition in the construction and surety industries, underscoring the need for balanced approaches that leverage technology without diminishing professional judgment. As the construction landscape continues to evolve, driven by factors such as climate change, urbanization, and technological innovation, the analysis of construction contracts will remain a dynamic and vital component of surety underwriting. By integrating historical insights, interdisciplinary methodologies, and advanced analytical tools, underwriters can navigate the complexities of construction contracts with precision and confidence, safeguarding both their interests and those of the projects they support. Project-based risk monitoring and loss control in surety bond underwriting is a dynamic process that integrates real-time oversight, data analysis, and proactive interventions to ensure the successful completion of bonded projects. Central to this effort is the real-time monitoring of projects, which involves regular progress reports and strategic job site visits. Progress reports provide a comprehensive overview of key metrics such as work completed, resources utilized, and financial expenditures to date. These reports allow underwriters to compare actual performance against contractual obligations, and forecast potential deviations that could escalate into claims. However, the reliability of progress reports depends heavily on the accuracy and timeliness of the information provided, necessitating stringent requirements for documentation and verification. Job site visits complement progress reports by offering an unfiltered view of project conditions, enabling underwriters to assess factors that may not be evident in written reports. For instance, site visits can reveal issues such as poor equipment maintenance, insufficient workforce allocation, or unsafe working conditions, each of which could lead to delays, cost overruns, or accidents. During these visits, underwriters or their representatives may also engage with project managers and subcontractors to evaluate communication dynamics, adherence to schedules, and the resolution of on-site challenges. Site visits further provide opportunities to validate that materials and equipment are being appropriately utilized and secured, reducing risks related to theft or mismanagement. The use of key performance indicators, KPIs, is another critical aspect of project-based risk monitoring. KPIs serve as measurable benchmarks that underwriters can track to evaluate project health and identify early warning signs of potential issues. Common KPIs in construction projects include Schedule Performance Indices, SPI, Cost Performance Indices, CPI, and Earned Value Metrics. The SPI measures whether a project is ahead or behind schedule by comparing planned progress to actual progress, while the CPI assesses budget adherence by comparing the value of completed work to actual costs incurred. Together, these indicators provide a robust framework for assessing whether the project is on track to meet its contractual obligations within the agreed timeline and budget. Additional KPIs, such as cash flow ratios and workforce productivity metrics, offer insights into a contractor's operational efficiency. For example, cash flow ratios can reveal whether incoming payments are sufficient to cover outgoing expenses, while productivity metrics evaluate the output per worker or crew against industry benchmarks. Underwriters must consider these indicators within the broader context of the project, recognizing that short-term fluctuations may not necessarily indicate systemic problems. For instance, a temporary dip in SPI may be recoverable if the contractor demonstrates the ability to reallocate resources effectively or implement corrective actions. Analyzing deviations in timelines, budgets, and milestones is an essential function in predicting potential claims. Deviations often arise from unforeseen circumstances such as weather delays, labor shortages, or supply chain disruptions. However, systemic issues such as inadequate project planning, poor subcontractor performance, or mismanagement of resources can also lead to significant variances. By comparing project performance against baseline schedules and budgets, underwriters can identify patterns or trends that signal escalating risks. For example, consistent delays in milestone completion may indicate deeper issues such as insufficient workforce capacity or delays in material procurement. Similarly, budget overruns that exceed contingency allowances may reflect poor cost control practices or unexpected price volatility in critical materials such as steel or concrete. Developing intervention strategies to mitigate risks during the project lifecycle is a proactive approach to loss control that requires close collaboration between underwriters, contractors, and project stakeholders. Interventions may include financial assistance, such as accelerating payments to subcontractors or suppliers to prevent work stoppages, or providing access to additional resources, such as equipment or specialized labor. Non-financial interventions, such as enhanced project management oversight, revised scheduling plans, or third-party audits, can also address underlying issues without incurring significant costs. For example, implementing a revised critical path method, CPM schedule, may help contractors identify and address bottlenecks, ensuring that key milestones are met. In high-risk scenarios, underwriters may consider invoking clauses in indemnity agreements or collateralizing additional assets to safeguard their interests. For instance, if a contractor exhibits signs of financial distress, requiring the posting of additional collateral or imposing stricter payment controls can reduce the likelihood of default. These measures, however, must be carefully calibrated to avoid further destabilizing the contractor or undermining project morale. Effective interventions often balance the need for risk mitigation with the goal of preserving relationships and ensuring project continuity. Historically, The evolution of project-based risk monitoring has been shaped by advancements in construction management practices and technological innovation. The introduction of Earned Value Management, EVM, in the mid-20th century revolutionized project oversight by integrating cost and schedule performance into a unified framework. More recently, the adoption of construction management software and real-time data analytics has enabled underwriters to monitor projects with unprecedented precision and granularity. For example, tools that integrate building information modeling, BIM, with financial and scheduling data allow for dynamic updates on project progress, enhancing the underwriter's ability to identify and respond to emerging risks. Interdisciplinary connections further enhance the effectiveness of project-based risk monitoring. Insights from behavioral science, for instance, shed light on how contractors and project managers respond to incentives, penalties, or external pressures. This understanding can inform the design of intervention strategies that align stakeholder interests and foster collaboration. Legal expertise is also critical in navigating the contractual and regulatory frameworks that govern construction projects, ensuring that interventions comply with relevant laws and do not inadvertently expose the surety to additional liabilities. Economic analysis provides valuable context for assessing market conditions, such as labor availability or material price trends, that may influence project performance. Contemporary debates in project-based risk monitoring often center on the role of technology in enhancing or replacing traditional oversight practices. Proponents of automation argue that tools such as drone-based site inspections, IoT-enabled equipment monitoring, and AI-driven risk analytics can improve accuracy, efficiency, and scalability. Critics, however, caution that over-reliance on technology may overlook qualitative factors such as contractor reputation, team dynamics, or stakeholder communication, which are often critical to project success. These debates reflect broader tensions between innovation and human expertise in the construction and surety industries. As construction projects become increasingly complex and interdependent, the principles and practices of project-based risk monitoring and loss control will continue to evolve. By integrating historical insights, advanced analytical tools, and interdisciplinary perspectives, underwriters can navigate the challenges of modern project oversight with confidence and precision, safeguarding their interests while supporting the successful completion of bonded obligations. The regulatory and legal frameworks governing surety bonds represent a complex interplay of federal, state, and local laws, designed to ensure the performance and payment obligations of contractors and safeguard the interests of project owners, subcontractors, and suppliers. A fundamental cornerstone of these frameworks is the Miller Act, enacted in 1935, which mandates performance and payment bonds for federal construction projects exceeding $250,000. The Miller Act's primary purpose is to protect the federal government from contractor default while ensuring that subcontractors and suppliers receive payment for their work. Unlike private projects where mechanics' liens are used to secure payment, federal property is exempt from lien claims, making surety bonds the sole remedy for unpaid parties on federal projects. The Act requires contractors to furnish two separate bonds: a performance bond guaranteeing the completion of the project according to contractual terms, and a payment bond ensuring compensation for labor and materials. Claims under the Miller Act must adhere to strict timelines, including a 90-day waiting period after the last provision of labor or materials, and a 1-year statute of limitations from the date of completion, creating a rigid but protective framework for stakeholders. At the state level, Little Miller Acts extend similar requirements to state-funded projects, though specific provisions vary significantly by jurisdiction. For example, some states impose different thresholds for mandatory bonding, such as $100,000 or $500,000, and others have additional requirements for sub-bonds at lower contract tiers. The procedural nuances of Little Miller Acts, including filing deadlines, claim processes, and allowable damages, necessitate a thorough understanding of state-specific regulations. In states like California, bond requirements include explicit language outlining the rights and obligations of claimants, while states like Texas have shorter filing windows for bond claims, placing a greater burden on subcontractors to act swiftly. This divergence in statutory frameworks highlights the challenges sureties face when underwriting bonds across multiple jurisdictions, requiring careful compliance monitoring to avoid legal pitfalls. Lien laws further complicate the regulatory landscape by intersecting with surety bond obligations, particularly in private construction projects. Mechanics liens provide subcontractors and suppliers with a security interest in the property they improved, enabling them to seek payment directly from the property owner in the event of non-payment by the contractor. However, the existence of a payment bond often supersedes the need for lien claims, as the bond provides an alternative mechanism for recovery. In jurisdictions where both liens and bonds coexist, underwriters must account for potential conflicts, such as double exposure to claims or overlapping obligations. For instance, if a subcontractor files both a lien and a bond claim, the surety may be forced to litigate the priority of these claims, particularly in states like Florida, where lien waivers and bond rights are intricately linked. Effective underwriting policies should explicitly address these scenarios, incorporating provisions that require claimants to elect between lien rights and bond claims to limit duplicative liabilities. Case studies on recent legal rulings provide critical insights into the evolving interpretation of bond obligations. In United States, XRL CRA Builders, LLC vs. Gulf Coast Construction Group, LLC 2020, the court clarified the scope of payment bond coverage under the Miller Act, emphasizing that suppliers furnishing materials to subcontractors were entitled to claim against the bond even when they had no direct relationship with the prime contractor. This ruling reinforced the broad protective intent of the Act, but also highlighted the need for underwriters to carefully assess the supply chain hierarchy when evaluating bond risks. Similarly, in Fleming Steel Cumber vs. Jacobs Engineering Group Inc. NR 2019, a state court ruling under Pennsylvania's Little Miller Act illustrated the importance of clear contract terms, as ambiguities in the performance bond language led to protracted litigation over liability apportionment between the contractor and the surety. These cases underscore the importance of precise bond drafting and the need for legal expertise to mitigate exposure to ambiguous or expansive interpretations. Navigating conflicts between regulatory requirements and underwriting policies requires a multifaceted approach that balances legal compliance with practical risk management. One common conflict arises when statutory bond requirements impose broader obligations than those typically included in underwriter policies. For example, some Little Miller Acts mandate coverage for consequential damages, such as delay-related losses, which many underwriting policies seek to exclude. To address this, sureties often include tailored endorsements or riders that reconcile statutory obligations with standard policy exclusions, ensuring both compliance and risk limitation. Another frequent challenge involves managing the interplay between indemnity agreements and public policy considerations. While indemnity clauses typically allow sureties to recover losses from principals, courts may limit enforcement if the terms are deemed overly burdensome or inconsistent with statutory protections. This is particularly relevant in cases where principals are individuals or small businesses, as public policy often seeks to preserve their economic viability despite contractual obligations. Historical developments provide valuable context for understanding the regulatory and legal frameworks governing surety bonds. The origins of the Miller Act trace back to the Hurd Act of 1894, which first introduced federal bond requirements in response to widespread contractor defaults on government projects. Over time, the limitations of the Hurd Act, particularly its lack of clarity regarding subcontractor rights, prompted the enactment of the Miller Act, which expanded and refined these protections. Similarly, the evolution of state lien laws and bonding statutes reflects a broader trend toward balancing the interests of owners, contractors, and suppliers, often in response to economic crises or construction industry lobbying efforts. For example, the widespread adoption of Little Miller Acts in the mid-20th century coincided with a period of increased public infrastructure investment, highlighting the role of legislative frameworks in facilitating economic development. Interdisciplinary connections further enrich the understanding of regulatory and legal frameworks. Economic analysis sheds light on the broader market implications of bond requirements, such as their impact on contractor pricing, project timelines, and competition within the construction industry. Legal theory offers insights into the balancing of contractual autonomy with statutory mandates, particularly in the context of indemnity enforcement and liability apportionment. Behavioral science contributes to understanding how contractors and subcontractors respond to regulatory incentives or disincentives, such as the deterrent effect of strict filing deadlines on frivolous claims. Contemporary debates in this field often center on the adequacy and adaptability of existing frameworks in addressing modern construction challenges. Proponents of reform argue that the rise of public-private partnerships and design-build contracts necessitates updated bonding requirements that reflect the complexities of these arrangements. Critics caution that expanding bond obligations may increase costs for contractors and discourage participation in public projects, particularly among small and minority-owned businesses. Advances in technology, such as blockchain-based contract management and AI-driven claim analysis, offer potential solutions to these challenges, but also raise questions about their compatibility with existing legal standards and regulatory oversight. As the construction industry continues to evolve in response to technological advancements, economic shifts, and environmental imperatives, the regulatory and legal frameworks governing surety bonds will remain a critical area of focus. By integrating historical insights, case law analysis, and interdisciplinary perspectives, underwriters can navigate these complexities with confidence, ensuring compliance while effectively managing risk. Credit scoring and portfolio risk diversification in surety bonds represent a sophisticated intersection of quantitative analysis, risk management theory, and practical underwriting strategies, tailored to navigate the unique challenges of the construction industry and other sectors requiring bonding. Advanced credit scoring models designed specifically for surety underwriting are central to assessing the financial health and performance potential of contractors. Unlike traditional credit scores, which often focus on consumer or corporate debt repayment behavior, surety-specific models incorporate additional variables such as financial ratios, work-in-progress schedules, historical claim rates, and qualitative factors like management stability and industry expertise. These models leverage machine learning algorithms and statistical techniques to predict default probabilities with high accuracy, integrating data from diverse sources including financial statements, macroeconomic indicators, and industry benchmarks. For instance, logistic regression and decision tree models are frequently employed to classify contractors into risk tiers, while neural networks may be used for more complex, nonlinear relationships between variables. The output of these models informs underwriting decisions, providing a probabilistic framework for determining bond terms, collateral requirements, and premium rates. Balancing high-risk, high-reward bonds with low-risk, low-reward opportunities is a critical component of portfolio management in surety underwriting. This balance is achieved through strategic diversification, which reduces the overall risk of the portfolio by spreading exposure across multiple contractors, industries, and project types. High-risk bonds, often associated with new or financially unstable contractors, carry the potential for greater profitability through higher premiums but also pose a greater likelihood of claims. Conversely, low-risk bonds, typically issued to established contractors with strong financial profiles, offer lower premiums but contribute to portfolio stability. Effective portfolio management involves allocating resources in a manner that optimizes the trade-off between risk and return. Techniques such as risk-adjusted return on capital, RAROC, and the Sharpe ratio are often applied to evaluate the performance of individual bonds within the context of the entire portfolio. These metrics provide a quantitative basis for determining the contribution of each bond to portfolio risk and profitability, enabling underwriters to make informed decisions about bond issuance and renewal. Monte Carlo simulations are a powerful tool for assessing portfolio risk in the context of surety bonds. These simulations involve generating thousands or even millions of potential scenarios for bond performance, based on probabilistic distributions of key variables such as contractor default rates, project delays, and economic conditions. By modeling a wide range of outcomes, Monte Carlo simulations provide underwriters with a comprehensive understanding of the portfolio's potential risk exposure under various conditions, including worst-case scenarios. For example, a Monte Carlo simulation might reveal the likelihood of a significant loss event if several high-risk contractors default simultaneously during an economic downturn. This information can inform decisions about portfolio composition, reserve allocation, and reinsurance strategies. The flexibility of Monte Carlo methods allows for the incorporation of interdependencies between variables, such as the correlation between economic downturns and increased default rates, providing a nuanced view of systemic risk. Setting exposure limits by contractor, industry, and geographic region is another practical framework for managing portfolio risk in surety underwriting. Exposure limits are designed to prevent over-concentration of risk in any single area, ensuring that the portfolio remains resilient to localized or sector-specific disruptions. For contractors, limits are typically based on a combination of their financial capacity, historical performance, and the size and complexity of the bonded project. Industry-based limits account for the varying risk profiles of different sectors. For example, residential construction may carry higher risk during economic recessions, while infrastructure projects may be more stable due to government funding. Geographic diversification addresses regional economic conditions, regulatory environments, and natural disaster risks, which can significantly impact project outcomes. The implementation of exposure limits often involves a hierarchical approach, with aggregate limits set at the portfolio level and individual limits applied to specific bonds or contractors. This layered structure allows underwriters to balance macro-level risk management with the flexibility needed to address unique circumstances. The historical context of credit scoring and portfolio diversification in surety underwriting provides valuable insights into the evolution of these practices. Early underwriting models relied heavily on qualitative assessments, such as personal relationships with contractors and subjective evaluations of their reputation and experience. The introduction of quantitative methods in the mid-20th century, driven by advances in financial analysis and statistical modeling, marked a significant shift toward data-driven decision-making. More recently, the integration of machine learning and big data analytics has further transformed the underwriting process, enabling the development of highly predictive and adaptive credit scoring models. These advancements reflect broader trends in financial services, where technology and data are increasingly central to risk management and operational efficiency. Interdisciplinary connections enrich the understanding and application of credit scoring and portfolio diversification in surety underwriting. Concepts from financial economics, such as portfolio theory and capital asset pricing models, provide a theoretical foundation for diversification strategies, while insights from behavioral finance shed light on the decision-making processes of contractors and underwriters. Operations research contributes advanced optimization techniques for portfolio management, enabling underwriters to allocate resources more effectively. Additionally, advancements in data science and artificial intelligence offer new opportunities for enhancing credit scoring models and risk assessment tools, improving the accuracy and efficiency of underwriting practices. Contemporary debates in this field often center on the role of automation and artificial intelligence in underwriting. Proponents argue that these technologies enhance the precision and scalability of credit scoring models, allowing underwriters to process larger volumes of data and identify subtle risk factors that might be overlooked by traditional methods. Critics, however, caution against over-reliance on automated systems, emphasizing the importance of human judgment in interpreting model outputs and addressing qualitative aspects of contractor risk. This debate reflects a broader tension between innovation and expertise in the insurance industry, highlighting the need for balanced approaches that integrate technological advancements with professional experience. As economic conditions, regulatory landscapes, and technological capabilities continue to evolve, the principles and practices of credit scoring and portfolio risk diversification will remain central to the discipline of surety underwriting. By combining advanced analytical tools, interdisciplinary insights, and practical frameworks, underwriters can navigate the complexities of modern risk management with confidence and precision, ensuring the stability and profitability of their portfolios while supporting the success of bonded projects. Emerging trends in construction risk management and surety bonds reflect the dynamic intersection of economic forces, technological innovation, and environmental considerations, each reshaping the strategies employed by underwriters to assess and mitigate risks. The impact of supply chain disruptions on bonded projects has become increasingly pronounced in recent years. With global events such as the COVID-19 pandemic and geopolitical tensions highlighting the fragility of construction supply chains, these disruptions manifest as delays in material delivery, cost escalations, and resource shortages, each contributing to project overruns and increasing the likelihood of claims against surety bonds. For underwriters, assessing supply chain risk involves analyzing the contractor's sourcing strategies, the diversity of their supplier base, and their ability to secure critical materials in volatile markets. Metrics such as lead times, inventory turnover, and supplier financial stability become central to evaluating a contractor's resilience. Advanced tools like supply chain simulation models and real-time tracking systems provide underwriters with actionable insights, enabling them to anticipate potential disruptions and recommend contingency measures such as alternative sourcing or inventory buffering. Technological advances in construction are simultaneously transforming project management practices and introducing new variables into the underwriting equation. Modular construction, for instance, offers significant benefits in terms of efficiency, cost control, and quality assurance, as components are prefabricated in controlled environments and assembled on site. However, this approach also concentrates risk in the prefabrication phase, where delays or defects can have cascading effects on project timelines. Underwriters must adapt by evaluating the capabilities and reliability of modular construction facilities, as well as the logistics involved in transporting large modules to project sites. Similarly, the adoption of artificial intelligence, AI, in project management is revolutionizing how contractors plan, monitor, and optimize their operations. AI-driven platforms analyze vast data sets to predict potential delays, allocate resources more efficiently, and identify bottlenecks before they occur. For sureties, these technologies offer valuable data streams for real-time risk monitoring, but also require new expertise to interpret and integrate these insights into underwriting decisions. The rise of robotics and automation on job sites further complicates risk assessment, as it shifts the nature of liability from human error to equipment malfunction or software failure, necessitating adjustments in performance bond evaluations. Environmental risks and sustainability trends are increasingly influencing construction underwriting, driven by heightened awareness of climate change and regulatory pressures for greener practices. Extreme weather events, such as hurricanes, floods, and wildfires, pose significant threats to project timelines, safety, and overall feasibility. Underwriters must incorporate climate risk assessments into their evaluations, analyzing factors such as the geographic location of projects, historical weather patterns, and the robustness of site-specific mitigation measures. Additionally, the push for sustainable construction practices introduces both opportunities and challenges for surety underwriting. Green building techniques, such as the use of renewable materials and energy-efficient designs, may reduce long-term operational risks, but often involve higher upfront costs and untested technologies. Contractors pursuing certification under programs like LEED or BREEAM face additional compliance requirements, which can strain budgets and schedules if not properly managed. Sureties must weigh the benefits of supporting environmentally responsible projects against the risks associated with new and evolving construction methods, often collaborating with environmental consultants to refine their risk models. Adapting underwriting strategies to address changing economic conditions and inflation is a perennial challenge, particularly in an era of heightened volatility. Inflation increases the cost of materials, labor, and equipment, often exceeding the contingencies built into project budgets and leading to financial strain for contractors. In response, underwriters must reassess traditional risk thresholds, placing greater emphasis on cost escalation clauses in contracts and the adequacy of contingency reserves. Escalation clauses that allow for periodic price adjustments based on market indices can provide a buffer against inflation but must be carefully drafted to avoid disputes. Additionally, underwriters must account for broader economic conditions, such as interest rate fluctuations and labor market dynamics, which influence contractor financing costs and workforce availability. The interplay between these factors requires a holistic approach to risk assessment, incorporating macroeconomic forecasting, contractor financial health analysis, and real-time market intelligence. The historical context of these trends underscores the evolving nature of construction risk management. Early surety practices focused primarily on financial solvency and operational experience, with limited consideration of external variables like supply chains or environmental factors. However, The globalization of construction markets and the increasing complexity of projects have expanded the scope of risk factors underwriters must evaluate. Events such as the 2008 financial crisis and subsequent economic recovery highlighted the vulnerabilities of contractors to macroeconomic shocks, prompting the industry to develop more sophisticated risk modeling techniques. Similarly, the growing frequency and severity of natural disasters have spurred advancements in climate risk assessment, integrating data from meteorological studies, geological surveys, and climate models into underwriting practices. Interdisciplinary connections further enhance the understanding and application of emerging trends in construction risk management. Supply chain management theories, such as the bullwhip effect and just-in-time inventory strategies, provide valuable insights into the vulnerabilities and efficiencies of contractor operations. Environmental science contributes methodologies for assessing climate risk and sustainability metrics, while data analytics and machine learning drive the development of predictive models for project performance. Legal expertise is also essential for navigating the regulatory landscape surrounding green building certifications, supply chain compliance, and emerging liability frameworks. Contemporary debates in this field often center on the balance between innovation and risk in adopting new technologies and methods. Proponents argue that embracing advancements like modular construction and AI-driven project management enhances efficiency, reduces waste, and improves overall project outcomes. Critics, however, caution that the rapid adoption of untested technologies may introduce unforeseen risks, particularly in large-scale projects with high stakes. The integration of sustainability into underwriting practices is similarly contentious, with some viewing it as an essential response to global environmental challenges, while others question the financial viability of green initiatives in a competitive construction market. These debates highlight the need for adaptive underwriting strategies that balance traditional risk management principles with the demands of a rapidly changing industry. As construction practices continue to evolve in response to technological, environmental, and economic forces, the role of surety underwriters will remain pivotal in supporting the industry's growth and resilience. By leveraging historical insights, interdisciplinary expertise, and cutting-edge tools, underwriters can navigate the complexities of emerging trends with precision and foresight, ensuring the stability and success of bonded projects in an increasingly dynamic landscape. Claims handling and recovery strategies for surety bonds form the cornerstone of effective risk management, ensuring that underwriters not only fulfill their obligations, but also mitigate financial losses through strategic interventions. The process begins with a detailed analysis of claim triggers, which are events or conditions that activate a surety bond's obligations. Common triggers include contractor default, failure to meet performance milestones, or non-payment to subcontractors and suppliers. Each trigger necessitates a nuanced approach to investigation, as the underlying causes often involve overlapping financial, operational, and contractual factors. For instance, a contractor's inability to complete a project may stem from cash flow issues, labor shortages, or disputes with project owners. Investigations must encompass a comprehensive review of financial records, project documentation, and contractual agreements to identify the root cause of the claim and determine the surety's exposure. Site visits, interviews with stakeholders, and forensic accounting analyses further enhance the depth and accuracy of investigations. Best practices in investigating bond claims emphasize the importance of impartiality, thorough documentation, and adherence to legal and regulatory standards. Impartiality ensures that the surety's actions are defensible and equitable, particularly in disputes where both the contractor and claimant present competing narratives. Documentation is critical not only for substantiating the surety's findings, but also for supporting potential recovery efforts and defending against litigation. Regulatory compliance, such as adhering to jurisdiction-specific timelines for claim acknowledgement and resolution, safeguards the surety against penalties and reputational harm. Advanced technologies, such as document management systems and data analytics platforms, can streamline the investigation process by organizing and analyzing large volumes of information, enabling faster and more informed decision-making. Negotiation tactics play a pivotal role in resolving bond claims efficiently and minimizing financial losses. Settlements often represent the most cost-effective resolution, avoiding the expense and uncertainty of litigation. Effective negotiation requires a deep understanding of the claim's merits, the contractual obligations of all parties, and the financial and reputational stakes involved. Techniques such as interest-based bargaining, which focuses on addressing the underlying needs and priorities of stakeholders, can foster collaborative solutions that satisfy both the claimant and the surety. In some cases, structured settlements or alternative dispute resolution mechanisms, such as mediation or arbitration, provide additional avenues for resolving claims without escalating to court proceedings. Negotiators must also consider the timing of settlements, balancing the need for swift resolution with the importance of conducting a thorough investigation to establish the surety's liability accurately. Strategies for asset recovery from indemnitors and enforcing collateral agreements are essential components of loss mitigation. Indemnitors, typically the contractor or their principals, are contractually obligated to reimburse the surety for claims paid under the bond. Recovery efforts often begin with a demand letter outlining the indemnitor's obligations and providing an opportunity for voluntary repayment. If this approach proves unsuccessful, the surety may initiate legal proceedings to secure a judgment against the indemnitor. In cases where collateral agreements are in place, the surety has the added advantage of accessing pledged assets to offset losses. Effective enforcement of collateral agreements requires meticulous record-keeping to ensure that security interests are perfected and legally enforceable under applicable laws, such as UCC Article 9. For instance, if the collateral includes real property, the surety must ensure that liens are properly recorded to preserve priority over competing claims. Regular audits and appraisals of collateral also ensure that its value remains sufficient to cover potential losses, accounting for depreciation or changes in market conditions. Post-claim review processes are critical for refining underwriting policies and improving risk models, transforming the insights gained from claims into actionable strategies for future risk mitigation. Reviews typically involve a retrospective analysis of the claim's causes, the effectiveness of the surety's response, and any systemic issues revealed during the investigation. For example, a pattern of claims involving contractors with similar financial profiles or project types may indicate a need to adjust underwriting criteria, such as requiring higher collateral or imposing stricter financial thresholds. Similarly, recurring issues with certain contract provisions, such as ambiguous change order clauses or inadequate cost escalation protections, may prompt revisions to standard contract templates or underwriting guidelines. Data from post-claim reviews can also inform the development of predictive risk models, incorporating variables such as contractor financial ratios, project complexity, and economic indicators to identify high-risk bonds before claims arise. The historical evolution of claims handling and recovery strategies provides valuable context for understanding their current practices. Early surety operations relied heavily on informal networks and manual processes to investigate and resolve claims, often resulting in inconsistent outcomes and limited recovery efforts. The professionalization of the surety industry in the mid-20th century, driven by advancements in legal frameworks and financial analysis, introduced standardized procedures for claims handling and recovery. More recently, technological innovations such as electronic data interchange, EDI, and blockchain-based contract management systems have further enhanced the efficiency and transparency of these processes, enabling sureties to handle claims with greater speed and precision. Interdisciplinary connections enrich the claims handling process by integrating insights from fields such as law, finance, and psychology. Legal expertise ensures compliance with jurisdiction-specific regulations and enhances the surety's ability to navigate complex contractual disputes. Financial analysis supports the accurate assessment of claims and the valuation of collateral, while behavioral science offers insights into negotiation dynamics and stakeholder decision-making. For example, understanding the psychological factors that influence indemnitors' willingness to cooperate can inform strategies for securing voluntary repayments or settlements. Contemporary debates in claims handling and recovery strategies often revolve around the role of technology and automation. Proponents argue that tools such as AI-driven risk assessment platforms and automated claims processing systems can reduce costs, improve accuracy, and enhance customer satisfaction. Critics, however, caution against over-reliance on technology, emphasizing the importance of human judgment in interpreting complex cases and maintaining stakeholder relationships. These debates reflect broader tensions between innovation and tradition in the insurance industry, highlighting the need for balanced approaches that leverage technological advancements while preserving the expertise and discretion of seasoned professionals. As the construction industry continues to evolve and new challenges emerge, the principles and practices of claims handling and recovery strategies will remain central to the surety bond industry. By integrating historical insights, interdisciplinary methodologies, and advanced analytical tools, sureties can navigate the complexities of claims resolution with confidence and precision, safeguarding their financial interests while supporting the stability and success of bonded projects. Building strategic partnerships with contractors and obligés is a foundational element of surety bond underwriting. Fostering an ecosystem of trust, collaboration, and shared objectives that enhances risk transparency, mitigates claims, and strengthens market positioning. Establishing long-term relationships with contractors requires a nuanced approach that goes beyond transactional interactions, emphasizing mutual understanding and proactive engagement. This begins with a comprehensive evaluation of the contractor's operations, financial health, and project history, conducted not solely for underwriting purposes, but also as a means of identifying areas where the surety can provide value. Regular communication, such as quarterly financial reviews or project progress discussions, ensures that the contractor remains aligned with the underwriter's expectations while offering a platform for early identification of potential risks. Transparency is further enhanced through the establishment of trust, achieved by demonstrating consistency, fairness, and a genuine commitment to the contractor's success. For instance, a surety might offer financial counseling or access to industry resources, positioning itself as a partner in the contractor's growth rather than merely a provider of risk mitigation services. Effective communication with obligés, typically project owners or government entities, is equally critical in mitigating claims and fostering confidence in the surety's capabilities. Obligés are often focused on the timely completion and quality of projects, and their satisfaction is directly tied to the surety's ability to address potential disruptions swiftly and decisively. Communication strategies should prioritize clarity, timeliness, and responsiveness, ensuring that obligees are informed of any developments that might impact project outcomes. For example, in the event of contractor performance issues, the surety should proactively engage with the obligé to outline corrective actions, timelines, and contingency plans. This transparency not only reduces the likelihood of disputes, but also reinforces the obligé's perception of the surety as a reliable and competent partner. Tailored communication approaches, such as dedicated account representatives or regular stakeholder meetings, further enhance these relationships, allowing obligés to voice concerns and contribute to collaborative solutions. Collaboration models that integrate the surety, contractors, and project stakeholders create a framework for risk-sharing and collective problem-solving, aligning the interests of all parties involved. These models often take the form of structured agreements that define roles, responsibilities, and mechanisms for addressing potential issues. For instance, a collaborative risk management plan might include joint monitoring of project milestones, shared contingency reserves, and pre-agreed escalation procedures for resolving disputes. By involving all stakeholders in the decision-making process, these models ensure that risks are managed proactively and equitably, reducing the likelihood of claims while fostering a sense of shared accountability. Technological tools, such as collaborative project management platforms, can further streamline these efforts by providing real-time access to data, facilitating communication, and enabling the coordinated resolution of challenges. The integration of such tools allows for the seamless sharing of information, ensuring that all parties remain aligned and informed throughout the project lifecycle. Leveraging strategic partnerships to improve underwriter market positioning and customer retention requires a deliberate focus on differentiation and value creation. By positioning themselves as trusted advisors rather than transactional providers, sureties can build a reputation for reliability and expertise that sets them apart in a competitive market. This can be achieved through tailored services, such as risk assessment workshops, industry benchmarking reports, or access to exclusive financial products designed to support contractors' growth. Additionally, partnerships with industry associations, trade groups, and regulatory bodies can enhance the surety's visibility and credibility, reinforcing its position as a leader in the field. Retention strategies should prioritize personalized engagement, such as recognizing contractors' milestones, offering loyalty incentives, or providing tailored solutions for complex projects. The cultivation of deep, long-term relationships not only reduces customer turnover, but also generates opportunities for cross-selling and upselling, further enhancing the surety's market presence and profitability. The historical evolution of strategic partnerships in the surety industry provides valuable insights into their enduring importance. Early surety practices were often characterized by ad hoc, transactional relationships, with limited emphasis on collaboration or long-term engagement. However, the increasing complexity of construction projects and the growing expectations of obligees have driven a shift toward more integrated and proactive approaches. The adoption of partnership-based models reflects broader trends in business relationship management, where trust, transparency, and mutual value creation have emerged as key drivers of success. This evolution underscores the importance of adapting to changing industry dynamics and customer needs, while maintaining a focus on core principles of integrity and accountability. Interdisciplinary connections further enhance the effectiveness of strategic partnerships, drawing on insights from fields such as behavioral science, organizational psychology, and economics. Behavioral science provides a framework for understanding the motivations and decision-making processes of contractors and obligees, informing strategies for building trust and fostering collaboration. Organizational psychology offers tools for managing stakeholder relationships, such as conflict resolution techniques and methods for enhancing team cohesion. Economic analysis supports the development of partnership models by quantifying the costs and benefits of collaborative approaches, enabling sureties to allocate resources more effectively and justify investments in relationship-building initiatives. Contemporary debates in this area often center on the balance between standardization and customization in partnership strategies. Proponents of standardization argue that consistent processes and frameworks enhance efficiency, scalability, and fairness, particularly in large, diverse portfolios. Critics, however, caution that overly rigid approaches may fail to account for the unique needs and preferences of individual contractors and obligees, potentially undermining relationship-building efforts. These debates highlight the need for flexible strategies that combine the efficiency of standardized processes with the adaptability of customized solutions, ensuring that partnerships remain responsive and relevant in a dynamic industry landscape. As the construction and surety industries continue to evolve, the principles and practices of building strategic partnerships will remain central to their success. By integrating historical insights, interdisciplinary expertise, and advanced tools, underwriters can cultivate relationships that enhance risk transparency, mitigate claims, and strengthen their market positioning, ensuring their continued relevance and competitiveness in an increasingly complex and interconnected environment.